Please see the full disclaimer on your screen before we begin.
Welcome to The Explainer. I am absolutely thrilled you're here today because, honestly, we are taking a massive leap. If you've been looking at the world of institutional-grade property investing and kind of feeling like it's this exclusive club hidden behind a giant wall of confusing jargon and opaque deal structures, listen, you are not alone. But today, we're breaking those walls down. Consider this your very first real step in mastering commercial real estate. Just think of me as your mentor guiding you through the whole shebang. Together, we're going to build a crystal-clear blueprint for how the pros actually look at properties, profit, and risk.
Okay, let's dive right into our syllabus for today. We'll be hitting 1. Demystifying commercial real estate. 2. The 3 asset pillars. 3. 4 core investment strategies. 4. The asset class matrix. And finally, 5. Assessing your execution capacity.
All right, kicking things off with Section 1, Demystifying Commercial Real Estate, Breaking Down the Walls.
Now, to invest with absolute, unshakable confidence, you really have to understand the landscape. And that starts with drawing a very hard line in the sand about what actually qualifies as commercial property. So multifamily housing refers to residential buildings with 5 or more units. Honestly, the number 5 is magic. If you buy a duplex, a triplex, or a fourplex, you are still technically playing in the residential space as far as lenders and appraisers are concerned. But the very second you cross into 5 units or more, boom, welcome to commercial real estate. This is the absolutely crucial dividing line between your everyday residential investing and stepping up to institutional-grade commercial assets. It completely changes how the property is valued, how it's financed, and how it operates day to day.
Moving right along to Section 2, the 3 asset pillars and finding the heartbeat.
In our framework, every single commercial property has a unique operational heartbeat. This heartbeat dictates exactly how the building collects revenue, manages expenses, and interacts with tenants. It's what defines the asset's stability and its profit potential. We call multifamily housing the bedrock asset. The heartbeat here, it's the short-term, typically 12-month individual lease. And the advantage is unbelievable resilience. Just think about it for a second. Everyone needs a place to live, right? If you own a single-family rental and your tenant moves out, your revenue literally drops by 100% overnight. But if you own a 100-unit commercial building and one tenant moves out, your revenue only drops by 1%. That is structural resilience at its finest. The standard play here is value-add optimization. You go in, update the kitchens, upgrade the amenities, tighten up the property management, and organically push those rents up. That directly forces the overall property value to climb.
Now, what's really interesting about this is how the triple net, or NNN, lease structure completely flips the script you might be used to. In a standard residential lease, the landlord is always on the hook for property taxes, building insurance, and, fixing the roof when it leaks. But in a triple net lease, the corporate tenant actually agrees to pay their base rent plus the 3 nets, the taxes, the insurance, and the maintenance. You are effectively passing the entire operational burden right back to the tenant.
And that makes triple net leases the ultimate hands-off income stream. The heartbeat here isn't 12 months. It's long-term corporate leases stretching 10 to 25 years. We're talking about national pharmacies, massive coffee chains, or major dollar stores. The advantage is ultra-low management friction. They maintain the building and you just collect a highly predictable, almost guaranteed check. It's actually very similar to familiar household income sources, kind of like receiving a steady dividend or a bond yield. Your primary play here is long-term wealth preservation and protecting yourself against inflation through built-in contractual rent escalations.
But hey, what if you want something faster, something more dynamic? Well, that brings us to our 3rd pillar, luxury hospitality, the high-yield operational engine. We just talked about decades-long leases, right? Luxury hospitality is the complete polar opposite. The heartbeat is nightly. You are literally releasing your inventory every single night. So this acts as a hybrid between real estate and a high-end operating business. The massive advantage here is the uncapped upside. Think about it. A luxury hotel can instantly quadruple its prices overnight for a Super Bowl or a Taylor Swift concert to capture that massive revenue spike. The usual play is operational repositioning, basically bringing in an elite management team to specifically target premium travelers.
Okay, on to Section 3, 4 core investment strategies, balancing risk versus return.
And this brilliantly illustrates a key point. While the asset pillar tells you what the physical building is, the investment strategy tells you exactly how you're going to generate profit, and crucially, how much risk you're assuming to get it. On one end of the spectrum, you have the core strategy, low risk, low return.
These are pristine, fully stabilized assets in major markets, like that triple-net corporate pharmacy we just talked about. They literally act like low-risk bonds. You buy it, you park your money, you collect your yield. Easy. But on the complete opposite end of the spectrum, that's the opportunistic strategy. High risk, maximum return. We're talking ground-up development, heavy adaptive reuse, like turning an abandoned suburban hotel into an apartment complex, or buying severely distressed assets out of foreclosure. It requires the absolute highest level of execution to pull off, but the financial rewards can be absolutely massive.
Right between those two extremes are the middle ground strategies, which is honestly where a lot of investors live. First up, Core Plus. This offers moderate risk and return. Think of a really high-quality, well-located multifamily building that just needs some minor operational tweaks or very light cosmetic updates to hit market rents. Then we have Value Add, medium-high risk, high return. Pay close attention here, because this is where significant wealth is often created. You are buying a property with real deficiencies, say a hotel that's only 65% occupied because the interiors are totally stuck in the 1990s. You bring in capital, you renovate, you aggressively lease it up, and you drastically increase the net operating income.
Section 4. The Asset Class Matrix. Aligning Risk and Deals.
Now that we have our asset pillars and our strategies, we need a reliable way to combine them. Consider this matrix your personal deliverable, a quick reference guide straight from the PRI Consulting Academy to help you perfectly align your risk tolerance with actual deal structures. Notice how the chosen strategy entirely dictates the timeline. If you choose a triple net asset using a core strategy, your typical holding period is going to be 10+ years. Your risk is low and your return driver is stable, predictable monthly cash flow. But step down a bit. Take a multifamily asset and apply a value add strategy, and suddenly your holding period shrinks to 3 to 5 years. Why? Well, because you're getting in, doing the heavy lifting of renovations to force appreciation, and then looking to exit or refinance. And if you go down to luxury hospitality with a value add or opportunistic strategy, you're looking at a 4 to 6 year window with high risk, relying heavily on an operational turnaround and dynamic pricing. This matrix absolutely proves that your strategy entirely dictates your hold time and your return.
Finally, we arrive at Section 5. Assessing your execution capacity, the final step.
So, the crucial point is this. This is honestly the most critical part of the entire blueprint. We've talked about the buildings and the math, but now we need to talk about you. As an investor stepping up to the plate, you have to do some honest self-reflection and use this simple check. Ask yourself, are you just looking for a predictable, hands-off check, or do you genuinely possess the highest level of execution capability? If you have a demanding full-time job and you just want to protect your capital from inflation, jumping into a heavy, adaptive reuse distressed hotel is a terrible idea for you, no matter how amazing the spreadsheet looks. You need that hands-off triple net lease. But if you have construction teams, management experience, and a high-risk tolerance, then absolutely, you have the execution capacity to chase those opportunistic yields. And that brings us to what is known as the PRI paradigm. Never judge a deal by its property type alone. Always match the strategy to your execution capacity. This is a massive paradigm shift. People so often assume an apartment building is always a safe bet, and a hotel is always risky. But think about it. A multifamily building undergoing a complete, massive gut rehabilitation is an incredibly risky, opportunistic play. Conversely, a luxury hotel that has an established world-class management team operating flawlessly during peak economic years, that can actually mimic a very stable core plus asset. The property type doesn't dictate the risk. The strategy and your specific ability to execute it dictates the risk.
Which leaves us with this final, provocative question. Will your next deal match your true execution capacity, or are you judging the risk purely by the property type? I really want you to think about that as you review the deals crossing your desk this week. Stop looking just at what the building is, and start looking at its heartbeat, its strategy, and whether you are genuinely equipped to execute the play. I truly hope this framework gives you the confidence to navigate commercial real estate like a seasoned pro. Keep learning, keep analyzing, and I'll catch you on the next explainer.